Hi, this is Diane Gilson with Info Plus Accounting, and welcome to today's QuickBooks Mystery Theater, the case of, so if I'm making a profit, why don't I have any money? The case to be solved, why don't my bank accounts reflect the profit that I see in my accrual-based financial statements? Or, what happened to my money? This is a common and logical question. I run into this in many cases with my clients, and it's definitely a question worth asking and finding an answer to. The situation is that accrual basis profit and loss reports show income earned and related costs. And this is best for management accounting purposes and for you to see exactly what's going on in your company from an activity standpoint, but cash doesn't always match up, and that's partly due to accounts receivable and accounts payable. Just because you invoice someone, the cash doesn't come in the door, and just because you've put a bill on the books doesn't mean that you've paid it. So there are at least those very basic differences, but in addition, there are a lot of other changes that happen in the balance sheet that don't actually show up in your profit and loss reports. So the solution is that we either look at existing reports in QuickBooks or take a look at an accounting report that's seldom used or reviewed but is available in QuickBooks. It's called the Statement of Cash Flows. This is a report that gives you a picture of changes in your cash position, and it rolls forward from what your profit and loss is into what your ending cash balance is at the current time. Accountants like to call this lots of times sources and uses of funds, and we'll kind of be referring to that phraseology as we go through here. So here's a little quiz. Which of the following are sources and which are uses of funds? Let's look at an increase in accounts payable, an increase in accounts receivable, purchasing equipment with a note payable. You make a payment on your credit card account, or you borrow against your line of credit. So this is a good spot to stop the video and make a note of your answers, because we're going to go through them on the next slide. You can just kind of check and see how you did on this. So our quiz answers are: an increase in accounts payable would represent a source of funds for you because you're acquiring something but not actually having any cash go out the door. An increase in accounts receivable would be a use of funds because you're actually financing someone else's activities. Purchasing equipment with a note payable, well, that ends up being both a source and a use of funds. The source is you're borrowing money or funds on a note that's going to be payable, but you're also purchasing equipment, which is a use of the funds that you are borrowing. You make a payment on your credit card. Well, that one's fairly straightforward because you know that money is going to be coming out of your bank account in order to reduce that liability. Or on the other hand, let's say you borrow against your line of credit. That will be a source of funds because funds will be coming into you while your liability is increased. So what I've done is put together a little bit of a get out of jail card or a cheat sheet to just so you don't have to think as heavily about this when you're looking at these different activities that you're doing. And here we have sources and uses on the left-hand side, and across the top we have big categories of activities. So if your bottom line is positive, of course that would represent a source of funds for you, and if you had a negative bottom line or a loss, that would actually be a use of funds on your side. Let's look at assets. If your assets are decreased, we'll use that accounts receivable example again. So let's say money comes in on accounts receivable. Your accounts receivable goes down because you have received incoming funds. So that would be a decrease. On the other hand, if you create receivables, that represents a use of your funds. And for liabilities, it's exactly the opposite. An increase in a liability would represent a source of funds to you because you're borrowing. And on the other hand, if you're reducing your borrowings or paying down those liabilities, that represents a use of funds. So let's talk about how to get QuickBooks to deliver the reports that show this information. One solution is to actually use a familiar report that can show you those changes. So that familiar report is a balance sheet, but we're going to do something special to it. We're going to show beginning and ending amounts, and we're going to add sub-columns, as you see over here on the right-hand side of the screen, for the previous period and the dollar change. Okay, and then here up above you'll see beginning and ending dates. You'll select those for your company. And you'll then see the differences for assets and liabilities as positive or negative amounts between beginning balances and ending balances. So without doing anything at all extra, you can see this information. However, the solution I kind of wanted to get to and introduce to you is to create the statement of cash flows report. And to do that, you just from the report center or from the main menu, you can select company and financial, that group of reports, and then you'll select the statement of cash flows. And what you'll do here is similar to what we did in the balance sheet by customizing it to show beginning and ending dates, and then of course you run the report. Now, it's a fairly lengthy report and not all that easy to show on the screen here. So what I'm going to do is show you the large groupings of information that show up on this report. So what happens is your report results will appear within these big groups, but you will see the individual accounts within each group. It starts out with the income or the loss as positive or negative for the accounting period that you're looking at, and then it will add or subtract activities that relate to your operations. And the accounts that it's going to look at in this particular area, without any modification on your side, are current assets and liabilities. Then it's going to show you positive or negative cash flow from investing activities, and these would be your longer term assets, so fixed assets or long-term assets, such as if you issued a land contract receivable or something along that line. And then for financing activities, that relates to your longer term liabilities, and again plus or minus based on those financing activities. Then what they do is add in the beginning cash, and the combination of all those numbers will give you your ending cash. And of course this should line up exactly with what's in your balance sheet if you add up all of your cash or bank accounts. So if you want to solve this case for yourself, for your company, you can use your existing QuickBooks reports, either the balance sheet or the statement of cash flows or both of them. You want to be sure that your books are clean and closed first. You want to add these reports to your month-end report package that you get, and then of course take a look at them regularly to track how and why your ending cash balance is different from your profits. And as a result, you'll be able to see exactly how your profits track through to your current cash position, which of course is what is kind of puzzling to people when they look at their reports and they look at their cash. This is Diane Gilson signing off for today's QuickBooks Mystery Theater. The case of, so if I'm making a profit, why don't I have any money? I hope that this helped to clarify that for you. And for construction accounting and job cost training and support, visit us at buildyournumbers.com and infoplusaccounting.com. Our toll-free phone number, 866-244-2228. Have a great day.